South Central Stocks. Let's get to it. When investing in stocks, did you know that you have options? But what are options? Options are contracts to buy or sell 100 shares of a stock at a certain price on or before a specific date. Options can be used to generate income or as a way to mitigate your losses. South Central Stocks. Let's get to it. This is not financial advice. The points and views expressed on this channel are my own opinion. When it comes to investing, you can do and choose as you like. Thank you. Okay, first of all, I want to start by saying if you find this information to be useful, please don't hesitate. Hit the like button, hit the subscribe button, and also hit the notification button so you can be informed for future shows on the South Central Stock Show. Okay, now let's get to it. If you want to be a more profitable trader and have a way to hedge your investments, then options might be something that you want to learn. So again, options are contracts to buy or sell 100 shares of a stock at a certain price on or before a certain date or time. So the two most basic forms of options are calls and puts. A call is when you want the stock price to go up, and a put is when you want the stock price to go down. Okay, so let's check out options. So basically, when you go to the stock, you're gonna do options on. Which today I'm gonna do. I'm gonna be doing. Where is she? Walt Disney. So when you go to the stock, you're gonna do options on. You want to find where it says options. Go to options, and then you should be brought to the screen similar to this, which is an option screen, and it'll show you, depending on how the layout is. It'll basically show you on right here. If you look on the left hand side, you'll see all these prices right here. These are called strike prices. And these are basically the prices that you could pick that you think the stock will be by that certain date. And where you pick the dates are usually up here. So these are all the expiration dates. As you can see, October 15th. Yeah, they're basically weekly. October 15th, October 22nd, October 29th, November 5th. So every week, this stock, Disney, has options that you can play every week. And as you can see, this one expires in 2 days. This one expires in 9 days, 16 days, 23 days, 30 days, so on and so forth. That's basically how the options table is laid out. Hold on, let's get back. So as I said, on the left hand, on all these strikes, these will be called strike prices. And these are basically the prices that you can choose from, that you think the price will be by whatever specified date that you pick. And then as you go over, right now we're on calls. Like I said, a call is an option for the price you want the stock price to go up. So it's on call right now. So we're looking at calls, different options that we can pick. And then when you get to the middle here, this is basically what the stock price is now. So 172.96 is the price of the stock right now. And when the stock price right here in the middle, the two prices, the price right above what the actual stock price is and the price below it, those are actually in the money, right in the money prices, meaning they're right at what the stock is, and they're called in the money. So when you pick those are like your most safest, non-risky bets that are pretty much going to be like, look at the delta on this one, 55% chance that it's going to be in the money. And then anything below the stock price is going to be considered out the money. So above the stock price is going to be in the money, and if it's below, it's going to be considered out the money. So that's something to keep in mind. And then when you go to puts, it's similar. It's pretty much the same setup. Strike prices are going to be in a is exactly the same setup. I'm sorry, put up. It basically shows you the strike prices on the side. It has all the same thing that you'll see the strike price. You'll see and then one very important thing, of course, I haven't explained yet. We'll go back to calls. When you look on the side, the price of the options. So as you see, most of these are expressed in small numbers. You'll see, okay, that looks like it says $8.30, $10.65, $5.80, $1.58, 54 cents. They're expressed in cents, but remember, options, you're buying options 100, you're buying an option to buy 100 shares of a stock. So you always have to multiply these numbers right here by 100. So basically, this stock part, the price for this option will be $158. It won't be. It's not $1.58. It's $158. You're buying that option contract. Another example: 54 cents. It won't be 54 cents. It's $54 to play this option. Another one: 20. You tell me what's that? That's $20 to play that. Not 20 cents. $20. $9. Let's go up here to some of the more expensive calls. $5.80, not $5.80, $580 to play that call. Now, mind you, while a lot of these prices may seem like they're kind of expensive, it would cost you more to actually own 100 shares of that stock. So you can actually leverage playing options, leverage your money a little better because you can get much higher gains by playing playing the options game. It's really not a game. It's real. So yeah, just a few basic things about options. I might have missed a few pointers, but we'll get into them later as the show progresses. Just want to get basically the people that don't know about options, and we can move forward from that point. So when you buy an option contract, you essentially want the price of the stock to go up or down by a certain time or date. Now let's talk about some indicators to predict how a stock options price might perform. Let's talk about the Greeks. So what are the Greeks? There's delta, gamma, theta, vega, and rho. I explained to you what each one of these are. So delta is the probability of an option being in the money by its expiration date. It tells you how much an option's price may change every dollar it goes up or down. The gamma measures the delta's expected rate of change. When you add the delta plus the gamma, you get the new delta, which will have impact on the next dollar move up or down. Vega, how much an option's price may change with each 1% change in volatility. And finally, but seldom used, rho, how much an option's chart price may change based on interest rates and the premiums. But that one, like I said, is seldom used as an indicator, but it's still on there. So okay, so as you can see here, the Greeks are usually be listed somewhere next to the strike price. As you can see on this one, delta 8613. So basically has an 86% chance of being in the money by the time the stock expires, the strike price expires on October 15th, which is this Friday. So it's an 86% chance that this stock is going to be in the money and pay off by the time it expires on Friday. And by the way, this is Nike stock I'm looking at. You know, you'll see that, okay, the delta, this one, 65% chance, 0.6522. So it's basically a 65% chance this one will be in the money. Nothing's for certain because, you know, we have different catalysts and things that you hear in the news during the day, but it's a 65% chance that this one will be in the money. Let's go to some of the ones that are kind of below the strike price. This one, for instance, what's the delta on this one? 39% chance. Not all the way 50% chance, but it's still good probabilities that this one will end up in the money. So you have delta, gamma, theta, Vega, and Rho. And once again, that theta is also one you want to look at because it's time decay. So no matter what happens each day, you're going to be losing a little bit of value from your options. So you want to always keep an eye on that to see. And time is definitely in your favor when you have options. So the longer you go out, the longer you pick out dates you pick out, then theta will definitely be it'll be on your side. So yeah, the Greeks, like I said, they normally be listed next to the strike price, and you can see this one. Basically, this one's Delta 9740, so it's a 97% chance, almost basically 100% chance that it's going to be in the money by Friday. And right now the price is 156.38 for Nike, and that strike price, if you pick that one, it's 149. So yeah, you can go through here, examine, check out the deltas, gamma, the theta, vega, the rho for each stock, and kind of get used to it. This is just a basic tutorial about options. There are several other things to learn about options, which we will definitely get into in other episodes. Options can be profitable and powerful, enabling you to get higher returns. However, they do come with a risk. So you should learn how to set a stop loss so you can minimize your losses in a trade. And a stop loss, in basic terms, is just setting the limit of how much you want to lose. And once it gets to that point, you can't lose any more than that point. You can just automate to set, I only want to lose 10%, I only want to lose 5%, 20%, whatever you want to risk, it's up to you. But once you set a stop loss, it's up to you. If the stock starts going down and it's to the point where when you feel like you lost enough or you don't want to lose any more money, you can set that stop loss. But for the most part, hopefully things go well for you when you're playing options and the stock either go up, down, sideways, whichever way that you initially wanted to go, so that your trading plans can come through and be successful. So yeah, you got options for sure. Just make sure you do the proper research, whether it's fundamental or price action. Put in the work so that you can make money whether the market goes up, down, sideways. Options give you those options actually. So that's it. Thanks for watching South Central Stocks. Let's get to it. Peace.